Hey everyone, it's Michael Beresford here from Open Corp. Back again for today's Property WOD. We're going through a ripper topic today, very topical. Basically what it is how to identify when a capital city market is in the danger zone or when we want to avoid buying an investment in that capital city. For those of you that have read Cam's book, My 4-Year-Old The Property Investor, you'll know exactly what I'm about to go through. It's called the development activity chain. And basically what it helps us understand is supply and demand and how developers' activity is impacting prices in a capital city market at any point in time. So, I'll draw it for you. We've got two lines here. Okay, now the top line is S for supply and the bottom line is D for demand. Okay, so basically what happens is if we think about what each of these two things is, then demand or an increase in demand is essentially people or population growth because that places an inherent demand on availability of housing. Supply is the available supply of property on the market at any point in time. Okay, so when we start to see a market increase in demand, and a really good example of that would be Melbourne right now, over the last 18 months to 2 years or thereabouts, population growth on the back of the job creation has been enormous. So we've seen a big increase in the demand for property. Supply hasn't kept pace. So we've got to this equilibrium point here, and then demand has continued to increase this way and eat into that available supply. Okay. Now, if we think about the Sydney market at this point in time, then this process has been ongoing for about 4 years, maybe a smidgen over in Sydney. Okay. Now, what that means is there's such a massive inherent demand based on minimal supply that this is where we actually get to this point in the market, which is the market hysteria. Okay, so the media is going nuts, the newspaper's filled with everything about how positive the market is, it's high flying. People that have sat out of the market for 2 or 3 years wanting to get comfortable around the thought of investing are thinking, well, maybe it's my time now to make some money. The problem is, this is the point here, right, where you're at major risk of not having your investments perform the way you want. And the reason for that is because at this point here, as demand started to increase, it wasn't only buyers that were active in the market, it was also developers. And if developers are acquiring development sites at this point in the market, it typically takes them about 2 to 3 years, okay, to bring on large amounts of land in a residential land subdivision, for example. Okay, and this activity is not isolated to one developer, it's developers across the board. So if you fast forward 2 to 3 years from this point, basically what we get to is what we call the danger zone. And that's here. Because what's happening is at this point, developers are dropping all of this extra supply. See how the supply really starts to increase rapidly. Developers are bringing that available supply onto the market. Okay, and as a result, demand just can't keep up, and that's when we see the correction. Okay, now it's not a widespread crash, but as you're starting to hear around the Sydney market at the moment, the media commentary has gone from hype to, oh, there's going to be a crash and it might drop, values might drop 30% or whatever it might be. That's the media hysteria around the fundamental activity of supply and demand and how population growth but massively developer activity influences that. And basically, when you start to hear this market hysteria, and when it's 2 to 3 years since we saw a rapid upswing in demand, that's the danger time not to invest in that capital city. So Sydney siders, I'm sorry, I love your capital city, I was there last week, but it's not the place that I'd be investing in Australia right now for this reason. We'll catch you next time.